India is the fastest growing economy in the world, has been for a while. But what does that mean for a non-resident Indian? 2025 has not been the best year for markets. Well, not here. The rest of the world has been just fine. But the long-term wealth creation, and more importantly, the return potential for India is up there. The question is, should an NRI dedicate a large portion of their investment corpus to India? And if so, what should they bear in mind about portfolio construction, about taxes, and the rules related to repatriation? That is, in the event that they don't intend to come back to India. There are some places where you even get taxed at 0%. Joining me on this episode of MoneyWise is Shalini Sekhri, the Chief Executive Officer of Renaissance Investment Managers. Shalini, welcome back to the show.
Thanks so much, Alex. Always fun to be here. Thanks for having me.
And this is right down your alley. In the past, we've spoken about, retirement, and we've spoken about certain other aspects and inheritance and various other things. But today, I'd like to ask you, you're speaking to a lot of people who invest from outside into India. Is India currently a hard sell for you?
So, Alex, India continues to be one of the most exciting economies in the world. And as you know, markets follow economies. We are in a phase that we call the economic miracle. So I don't know if you've heard that. But it took us, 65 years to add the first 4 trillion of economic output, what we call GDP. And all reports suggest that we will add another 4 trillion, doubling from here in just 7 years. These phases come maybe once in a century in a country's history. And I think we are blessed to be alive at this time and to actually be seeing all of this play out. We all know that India is today the 4th largest economy. In spite of that, we are barely about 3.5% of the world's GDP as we speak. I think in under 10 years, that number would go to 7%. We would be a 10 trillion GDP economy. So I think these 15, 20 years are what we all call the golden years of the economy. And I think the bigger risk today is to not be in India rather than to be in India. As we know, stock markets do follow the economy. And if you look at the numbers, they've actually been stunning. So the last, say, 20 years, 10 years, 5 years, anywhere between 13 to 15% annualized GDP, annualized return at just a nifty 50 level. We're just talking about the index. So when you kind of look at that, I think it makes us the second most large economy with those kind of returns after just the US. So for any international investor, whether a non-resident Indian or even a global investor, honestly, there's no getting away from India. So while there will be a lot of short-term noise, for the first time in history, we've been both in a physical, as in a geopolitical war all around the world, and an economic war. So when the largest country in the world unleashes trade wars on every country in the world, it is an economic war. So this confluence, I think we've probably not seen since the Second World War.
Yes.
So while there will be all of these noises, we all know that the best time really to start your investments is when you get these very brief opportunities in time to really, enter at the right point. And as we were discussing, smart money or the knowledgeable investor is really taking the bull by the horns, and we do continue to see that money flow in. Maybe the more retail investor is still trying to be a bit cautious, but as they say, you invest when others are fearful, and that's when you really make good money.
Okay, that's well answered. And even if it is a hard sell, I think you're doing a pretty good job, Shalini. So let me ask you this then. And before we get into portfolio construction and what you're talking to your clients about, when you are a non-resident Indian, I suppose what you're thinking about is what you need the funds for. Of course, you need it for what everybody else needs it. But are you going to take the money out eventually, or are you going to keep it in and move back to India? Is that something that you say is the first thing that you think about?
Sure. So portfolio investing can happen whether you intend to move back to India or not, right?
Okay.
So I think that all options are possible. But when you look at investing in India for NRIs, I would say as important as the product basket is really for them to understand how you route your capital, right? How repatriable will it be? How do you avoid tax leakages? And how is this going to compound in the long term?
Okay.
So I would say this is an equally critical part of it. And then obviously your decision on where to invest will get colored by, do you eventually want this money in India, to come back home when you retire? Or do you want to take all of this back out and have the money, freely moving between countries?
So let's look at each of these, because you talked about, and I hope I remember correctly, you're talking about the route, you're talking about repatriability, and you're talking about tax leakages, right?
That's right.
So let's talk about each one of these three issues so that everyone's on the same page. When you talk about routing of the money, you're talking about how you deploy money in India. How do you deploy money in India?
Sure. So there are two basic types of bank accounts that you would set up in terms of the infrastructure you require to really invest in India, right? One is the non-resident external account, or what we call an NRE account. This would be for money that you have not earned in India. So any money where the source of funds, which has been earned outside India, is freely repatriable. So ideally, you need to set up an NRE account in India, bring money in there from wherever in the world you have that money. You can invest it. And in most instances, the principal plus the return can be freely taken out because this money to begin with was not earned in India.
You said in most cases, are there restrictions?
There are, for example, in rental income, the rent, because it's earned in India, though your original purchase of the house might have been from, money earned overseas, the rent has to come into an NRO account.
Okay.
So the other kind of account being a non-resident ordinary account. This is for income earned in India. So you might have, say, sold shares in India, you might have received an inheritance, you might receive rent.
So what about dividend income?
So dividend income on shares that you have here would come into an NRO account.
Interesting. Okay.
Yeah.
Okay. So go ahead. So you have to create this NRE account, but you also have to have an NRO account.
That's
if
right.
If you're earning, and so if you're, I would guess if you're earning through mutual funds, you would generally not suggest a dividend option. You would choose to have it as a growth option in most situations.
So there are other interesting exceptions, right? So NRIs, for example, if they have NRO money in India, which is invested here, the dividend and interest part is freely repatriable.
Oh, interesting.
There's no cap. Otherwise, as you know, for even NRIs to take money out, there is a, liberalized remittance scheme limit, which is $1 million a year, right? Sure. But this does not count under that limit. So which means that if you've earned a dividend or an interest income, you can take it out from shares.
Sure.
Or, a fixed deposit interest, for example. So there are all some of these textures to, some of the underlying. But largely, I would say the broad rule is if you have earned this money outside and brought it into India, into an NRE account, you can take it out freely. Alternately, you've earned it in India and it needs to stay in an NRO account and it's for your use in India.
Okay, so this is routing. Where does GIFT come into play?
So GIFT is a big subject. So this is a new concept that was set up a few years ago, right? Basically to rival the great financial centers of the world like Dubai, Hong Kong, Singapore. So what the government of India has done is it has set up something called GIFT, basically stands for Gujarat International Finance Tech City.
Yeah.
It is
GIFT is easier.
Yeah, it is. It's set up as a free trade zone, so to say, for financial services, which means that while it is in Gujarat, India, and within the borders of the land, it is treated as an international or a foreign jurisdiction. And it has its own rules and regulations, and they have tried to make it extremely attractive from a taxation and an ease of doing business for NRIs and other foreigners as well to come into India and invest in India. Similarly, Indians can use this route to also invest internationally. So Gift City is another place that you can use, and taxation is an incredible benefit if you use the gift route, and we should talk a bit about that.
We will eventually, but so in terms of routing though?
So routing, clients can set up a multi-currency bank account in Gift City. So there are all the large banks, including ICICI, HDFC, all of these that are today present there. You can open a bank account there, and you can bring your money into a Gift City bank account. This is again fully repatriable. There are pretty much no restrictions because in a way it's not in India, right? Conceptually. So that becomes again very easy for clients to move money in and out. And all the large broking houses, asset management companies, mutual fund houses have set up operations there. So you can really access a very wide range of products by using the Gift City route. One is to bring money, but then also have access to investment products.
Okay, so therefore, is there anything else that somebody should know about routing money into India? If you have the option, should you opt for gift as opposed to a traditional route?
So it really depends on what you're buying and whether those options are available currently as we speak in gifts. So that's number one. Secondly, it also depends on whether you eventually do want to move back to India, in which case you may be fine using the NRE route, because then you've already established a banking relationship in India. You get to know your bankers, you start building a corpus there. So to that extent, I would say if you're unlikely to return to India, gift would be the logical choice. If you do intend to move back, then I guess it really depends. India and an NRE account may also make sense. But I think from a tax benefit perspective that investors are currently enjoying, gift may still make sense. You can eventually still bring the money to India, right? From
Interesting.
Gift. Yeah.
Moving to the second point which you made, which was repatriation, and you've already spelled out the fact that a lot of the money that you invest from outside in can be repatriated fairly easily. Is there anything else that somebody needs to bear in mind? Are there off cases that you need to pay attention to? And two, if you do decide to move back to India, when you do, is there a process for you to follow to move those monies outside of the NRE into a normal account?
So eventually, to take your second question first, the NRE accounts or a NRO account eventually will get converted to a resident India account, right? So eventually, your status, once you come back, one of the first things you do is really to fix your KYC, because you would now have a resident Indian address as opposed to an overseas address. Your bank account status needs to change. So all of those processes have to be, gone through eventually. And the same account tends to morph into the resident Indian status. So that's all easily done, via the banker. In terms of routing, I would say I think we've pretty much covered everything. Clients, of course, will also have to kind of take advice, I would say, from their advisors back home. Are there any complexities in terms of, so while we do talk about, say, preferential taxation, very often, in spite of having a double taxation avoidance treaty, because the rates of tax are different in different countries, the investor back home may still be liable, say, to some taxes. So he may decide whether he wants to route the money back, he wants to leave it in India. So all of those will come into play, because there are a lot of countries where tax rates are significantly higher than what we have for, say, capital gains in India, right? And they would need to pay that differential tax back home. So
because you speak about it from the perspective of a Dubai or the UAE, and you say that, it's 0% there, so it's a big benefit. But the opposite is also true. You could have situations where long-term capital gains is more than 12.5%.
There certainly are many, many countries where it's much higher, in excess of 30-40%.
Wow.
Yeah. So that's something also the investor needs to keep in mind, that where does it make sense for him to hold this money? And especially when investors are planning to move back to India, it's a lot of decisions around where you want to crystallize your capital gains. Is it beneficial to do it when you're still a resident of your current country, or is it better to then change your status and then, create your capital gains? So this is tax is a complex subject. It depends on where you live and, all of that. So
the beauty of these investments, of course, is that you can pay tax whenever you do redeem, and there's nobody holding a gun to your head, hopefully, and asking you to redeem. But so we've kind of covered the tax aspect as well. Do you want to talk about the gift city angle here with regard to the tax aspect?
Sure. So there would be, I would say, 4 or 5 key parameters where there are differences between coming into rupee products in India onshore versus investing through Gift City. And I would say the big game changer is that capital gains tax, if those funds are registered as what's called a specified fund under a certain income tax regulation, is subject to 0% capital gains tax. So let's take an example of, say, a Dubai investor in this case, right? So he invests in a mutual fund through a fund of fund structure in, say, Gift City, and that fund does only one thing: it buys units of an Indian mutual fund. Now, because of the tax breaks or the tax advantage given, when an investor redeems his units in, say, Gift City, there'll be no tax on the Indian end because there's no TDS for Gift City. And Gift City has no tax, and Dubai has no tax.
Right.
So you've used a mutual fund vehicle, you've used the Gift City benefit, and the fact that you're from Dubai or Singapore, Hong Kong, these are countries where there's no capital gains tax. In effect, you've had a zero tax capital gains investment.
Wow.
Which
Okay.
is really, huge. So that's on the short-term and long-term capital gains taxation. The other big benefit is that in GIFT City, there is no tax deducted at source. So for non-resident Indians, one of the big disadvantages is that whatever is the tax payable, which can be as high as 30% when you redeem a debt fund, it's all deducted at source.
Right.
And then if you have to claim it back, you have to go through the whole, tax process of claiming refunds.
Yeah.
GIFT City, there is no TDS, which means you're then just subject to whatever is the tax in your own home country. So if it's a rate that's better than what it is in, say, India, you have this huge benefit that your money is not held back at source, right? So that's a second huge benefit. Thirdly, there is no GST in GIFT City,
Okay.
which means that all your management fees that you're paying to managers like us do not attract that 18%, GST, right?
Okay, which is a considerable saving.
Which is a saving. And then there's also the STT, which is a transaction tax every time you buy and sell an equity share, which does not exist in GIFT City.
So there are several considerable...
So there are several benefits which have been given because the government is obviously trying to promote GIFT City. They are wooing actively, Indian fund managers who are based in, say, Mauritius or Cayman, all these traditional places to come to GIFT.
So one of the aspects and the reason why perhaps the government is doing this is because it wants that foreign capital to come through, right?
Absolutely.
It wants dollars to come through.
Yes.
And so therefore it's important to talk about currency as well.
Yeah.
We're speaking at a time, Shalini, when the rupee has been facing a spate of terrible weakness. And this is a sign of the times. The external scenario is uncertain.
Sure.
Tariffs and the threat of tariffs exists. And so with that context, the rupee has slid, but it also means that a foreign investor investing in India has lost out to a certain extent. Is that something to bear in mind, considering that with inflation where it is, and of course, last year is an aberration, or the current scenario is an aberration, but if it hovers around that 4.5% level, at some point there is going to be rupee depreciation. So you'd have to shave that off of what you're earning, right?
Of your return. So about 3.5% has been the long-term rupee to dollar depreciation, right? And I think most international investors do keep in mind that that is going to be a leakage on the return. And in spite of that, the kind of returns that you see in India is so compelling that still makes a lot of sense. A lot of people do ask us that why don't you hedge the currency risk, right? And the simple answer to that is that the cost of hedging is so high, and that's a fixed cost, it's not open to interpretation, is higher than actually the average depreciation of long-term depreciation. So you're taking that hit, which may be much higher than what the actual currency depreciation might be. So if we as active fund managers in India are telling our investors that you should expect 15 to 20% rupee return post fees, for an NRI investor who's looking at this depreciation, he would probably expect something like a 12 to 15% return, right? The other thing to keep in mind, Alex, is that we've already had a very sharp currency move recently, right? So we keep telling our investors who are looking to invest now that a big move is already behind you. So from a perspective of building a new portfolio, looking to taking exposure to India now, it's potentially a very good time because we're not expecting such a sharp.
You want to drive home that point because, Shalini, you spoke about 3.5% per year.
Yeah.
But as we know, the currency markets, like the equity markets, do not move in a linear fashion. You're talking about over a period of time. And there are spates of time or periods of time concentrated usually where there is a sharp move as we've seen in 2025 and so far in 2026. Right?
That's right.
It might actually move the other way for a bit, which is a significant positive.
Yeah, that's true. So assuming that a trade deal comes through or we have some kind of these positive signals, it's entirely possible that the currency might even strengthen briefly. But we do know over the long term, it's a slowly depreciating currency. But from the perspective that we've already had that sharp move, as you know, we've depreciated, I think, over 6% last year.
Yeah.
Which
and
means
further,
and we're continuing to see that. And so that's where I think that big move, like you said, it's non-linear. So one of the step function kind of moves has happened in the recent past. So while one should still plan for some bit of depreciation, I think from building a portfolio perspective for an NRI, it's not a bad time. And also, of course, for clients who intend to keep their money in India, it's a great time to send money here because you're getting more rupees per the dollar,
Yeah.
and it's going to be sitting in India waiting for you whenever you come home.
Yeah,
So-
some of those memes come to mind, right? People coming back to India say, what? Rupees now at 95, 90 rupees? And it used to be 40 rupees when I was back here. Anyway, but the point is that it's still the best market globally, or at least one of the best markets globally to invest in. Strategy. Let's talk about that in portfolio construction. Of course, no one-size-fit-all solution, but how do you help people at this moment try to make sense of the landscape? The tendency here in India has been to gravitate towards the broader end of the market. I'm guessing that isn't the case when you're advising your clients.
Like we said, I think for non-residents, it's only partly about the products, etc., right? So their long-term goals. So let's say think about it as a core and a satellite kind of an allocation strategy, right? So I think the core for everybody still has to be equity mutual funds, direct equity. And so that would be a fairly significant part of the portfolio, I think, for anybody to capture this amazing India growth story that we're seeing playing out, right? So I think that's a great long-term compounder. We can also look at it with the lens of, say, what life stage the NRI is at. So say someone in their 40s, they're probably not coming back to India anytime soon. They have 20 years of an investing life left. They're not relying on this money to, earn their day-to-day living. And they have the stomach for volatility. So I would say people like this would have a higher allocation to what we call core and alpha strategies. So core being obviously equity mutual funds or direct equity, either managed oneself or through a PMS or a AIF Cat 3 manager. The alpha part comes from maybe some of these category 2 alternate investment funds where you look at private equity, venture capital, special situation funds. You could take some exposure to that because everyone wants a little kicker of a return.
Those
right?
have a threshold, right?
Those are higher tickets typically, yes. Gift City, for example, everything is 150,000 minimum. In India, AIFs are 1 crore minimum. So that's maybe for the slightly, more HNI investor. You also have real estate. NRIs can buy commercial property or residential apartments. They're not allowed to buy agricultural land, for example. An alternate to real estate is also the whole real estate investment trust, right? The REITs. Then you have the infrastructure trusts, which are the InvITs. All of these are required to pay 90% of their income out to investors, right, on an ongoing basis. So that could be really your alpha and diversification strategy because these behave very differently than listed equity. So your private equity funds have very little correlation to listed equity, real estate as well as very little correlation to equity. And then, of course, you would have your the stability part, which could be, a fixed deposit or, something fairly short-term debt mutual funds, for example.
Not arbitrage funds?
I think for an NRI, that really doesn't make that much sense. They can, mostly they would not look at very short-term liquid funds and that kind of thing. They would largely look at maybe fixed deposits for their liquid part of their portfolio. So I would say that people should really look at these 3 buckets, which is your core equity. You layer it with some alpha generating strategies for a little bit of a return kicker. You throw in a bit of yield. If you look at, in fact, real estate and REITs, they're in a way a great inflation hedge as well because you keep raising rents, right? So as there's inflation in the economy, not only do you get a regular income, but because rents keep going up, it also kind of adjusts for inflation. So that's a great opportunity. And then you have your stable fixed deposit kind of play. So combination of all of this for a more conservative investor, I would say, who's maybe in his 50s preparing to return to India, would lead to maybe a 10 to 12% kind of a annualized return. And for someone who can go maybe 80% into the core plus alpha, so that's equity plus some of these other strategies, could look at anywhere from a 14 to 15% annualized return.
Interesting.
And I think that's quite healthy because with a good, I would say, asset allocation and diversification, the risk is also quite low. And that would really kind of help them navigate through all kinds of cycles. Like in the ETF space, you can buy a gold and a silver ETF, for example, right?
So, and just at the climax of this conversation, we talked about India and India necessarily being a part of portfolios for NRIs. But let's face it, the world is their oyster, right? They've got so many markets that they can invest in. So too do people in India, but to a lesser extent. What portion of their portfolio, in your opinion, should be India?
So as we discussed, Alex, after the US, I think the only other large, compelling economy in the world is India, which
China?
is So India is expected to grow structurally, whereas China might be a short-term tactical play. Even when we talk to very sophisticated institutional investors, they think about China for 1 year, 2 years, whereas India is straight away a 15, 20-year story, right? So I think for NRIs who understand India, while foreigners might find the chaos of India a bit daunting and a bit challenging, they don't know how to navigate it, they don't know what route to come in, who to work with. But for the Indian diaspora, I would say, who has roots here, who sees everything that's happening here, I think it should be a significant part of the allocation. So I would say 30% is really no problem, because the US will always have, say, a large allocation, and then there are other emerging markets and so on. But if you're a person of Indian origin, whether or not you intend to come back to live here, you understand India well. And you see it so closely, right? So you understand exactly what's happening. And with that, I think, as a backdrop, I don't think that you're going to put like a 10, 15% in India, right? India is going to be very core to your strategy. And I think, I would easily say 30, 40%. And most of the NRIs we talk to would have more than 50% in
Interesting.
India.
Okay. So on that note, Shalini, thanks so much for taking the time. Always a pleasure speaking with you.
Time always flies with you, Alex. So thank you, and hope to be back soon.
That's a lovely compliment. All right. Well, I hope time has flown for you as well. And let us know what you think in the comment section. And do stay tuned. This is NDTV Profit.